Thanks for joining this FP&A and Finance Insights video. I'm Jack Alexander. The subject of today's video is the great metrics debate, comparing earnings per share, EPS, ROE, ROIC, and EVA. Just a bit before we dive into the subject matter on the channel and the playlist within this, and my objective for this channel is that I've had a blessed career, 50 years experience as a CFO, advisor, author, and MBA lecturer. And so I wanted to pay this forward and share it with short focused sessions on important topics. The playlists that we have in this channel are listed below. We'll be adding to this each week. And many of the topics, illustrations, and models are based on my latest book in the upper right-hand corner, Financial Management. And that book comes with an accompanying website that has all of the models, Excel spreadsheets, and everything that we're illustrating. Today, we'll be covering material from both Chapter 2 on financial statement basics and analysis, and on Chapter 6, ROIC and growth, the ultimate drivers of value. So this video is part of the FP&A Best Practices and Tools playlist, and the topics we'll cover today, we're going to introduce the subject and talk about the objectives of measurement, and then we're going to talk about the problem with income-only measures like EPS or profitability. We'll go through the return type of measures, return on assets, equity, and invested capital, also known as net assets, net investment. And then we'll look at economic profit and the EVA, and then we'll provide a comparative summary and some final thoughts. So to begin the great metrics debate, we really need to take a step back and ask ourselves, what is it that we're trying to measure? Are we trying to measure performance? Are we trying to measure the potential for value creation? Are we looking to design compensation and incentive plans? And the answer is likely to be all three of those. And so we need to be thoughtful about how we construct the measures. Whatever gets managed, whatever gets measured gets managed, and it will influence behavior. So we have to be thoughtful about this. And since our objective in any corporation is to create value for shareholders, this has to be considered in selecting the metrics and the framework, providing a context for the business, any business decision, facilitating the evaluation of alternative strategies. Really, any business decision should really consider and be at least present and look at the critical measures that we select. So I advocate the use of a value performance framework. And this framework looks at shareholder value at the top, recognizes that external factors play a role, but in almost all businesses, shareholder value is going to be determined by the expectations of future performance on 6 value drivers: revenue growth, relative pricing strength or competitive position, operational effectiveness, capital management effectiveness, the cost of capital of the enterprise, and then the intangibles, things like credibility and superior management. So once we identify those 6 drivers, we can look underneath that to look at the critical business processes and activities that drive those, and then establish measures underneath that. So we'll come back to this as we evaluate some of the individual measures. All right, income-only measures, things like profitability, net income, earnings per share. And really, despite the limitations that we're going to discuss, EPS and other income measures remain the most commonly used measures of performance. And these are really used, they're pervasive throughout the capital markets. And you will hear CEOs and analysts talk about EPS and EPS growth. Profitability is net income divided by revenue. It's not a bad measure, it's just incomplete. Earnings per share, not a bad measure, just incomplete. What is the net income available to each share? EBITDA, earnings before interest, taxes, depreciation, and amortization, is another commonly used measure. It's a key element, but it's an incomplete measure of cash flow. Doesn't include what or consider what the requirements are for working capital needs or future capital investments, but it's widely used in private equity and M&A transactions. So all of these measures do not consider the capital required to generate the income or the level of cash generated from the operations. All right, let's talk about a few overall measures of performance that do include a capital component. Return on assets, and we're going through the LSA technology examples. These are included in the financial statement analysis video. If you want to watch that for more detail, encourage you to do that. And from chapter 2 of the financial management book. This ROA is simply net income divided by assets. So it measures the level of income generated on the assets employed by the firm. It is a good overall measure of effectiveness since it considers the level of income relative to the level of assets employed in the business. Return on equity, a similar measure, looks at net income divided by equity, shareholders' equity. And it obviously measures the return on the book value of the company's equity, the capital that's contributed by shareholders on a historical basis, we might add. So it's a good measure. The ROE will generally be greater than the ROA, and this is because part of the capital of the firm is provided by bondholders or debtors, other debtors, and also some portion of the assets are offset by operating liabilities. So we start with assets, we reduce it by operating liabilities, and then by debt to come down to equity. So I can't think of a circumstance where ROE would be greater than, where ROA would be less than ROE. Okay, one of the advantages of ROE, though, and this was developed in the early 1900s by the DuPont Corporation, is the return on equity tree. And this can allow us to understand the drivers of ROE, and using basic math principles, we can blow up or extend out the ROE computation to include profitability, net income divided by sales, asset turnover, sales divided by assets, and financial leverage, assets divided by equity. And you mathematicians will see that a couple numerators and denominators cancel out there, leaving us with the original net income divided by equity. So for LSA, it's 17.4% return on equity, as we saw in the previous slide. But now we have a little more insight and see that that's based on 9.5% profitability, 1.28 times asset turnover, 1.43 financial leverage. We can further use that DuPont formula to extend down and analyze and model return on equity. So in this case, we've got the profitability blown down into the P&L, a capsule P&L there that shows the net income is 9.5%. Again, asset turnover in the middle block is 1.28 and leverage of 1.43. But this simple spreadsheet, simple model, allows us to do what-if analysis. What would be the change in ROE if we improved profitability from 9.5 to 10%? What would be the impact on ROE if we improved asset turnover and increased it, say, to 1.5? What would be the effect on ROE if we restructured the capital base and added more leverage, additional borrowing, and reduced the level of equity involved? And so this is a great tool to understand the sensitivity of ROE to those drivers. Another overall measure of performance is return on invested capital, also known as return on capital, return on net investment, and return on net investment, which was the measure that I grew up with and eventually oversaw. So what we do here is we take earnings before interest after tax, or operating profit after tax, or net operating profit after tax, generally synonyms, and we divide that by invested capital, which represents the sum of debt plus equity. So this measures the income available to all suppliers of capital, both debt and equity, compared to the total capital provided from those same sources, the total of debt and equity. Another way of looking at ROIC is that the measure indicates the amount of income a company earns for each dollar invested in the company. It's a terrific measure of overall financial performance. So let's look at Robert's company now, a different example for comparison and analysis of these measures. So this is a P&L and then both sides of the balance sheet shown on the left. And in previous videos, including the financial statement analysis, I suggest the presentation on the right for the balance sheet. And that is that we move the operating liabilities from the right-hand side of the balance sheet to underneath our operating assets so that we arrive with net operating assets or invested capital. And that leaves the right-hand side very clearly representing the sources of capital, debt, and shareholders' equity. So in looking at return on equity, which is presented here, we've got it broken out between net income of 16.15%. We've got asset turnover a little over 2, and we've got leverage about 1.5, yielding an ROE of 50.8. Okay, this is an eye chart, but I wanted to just plant the seed that you can, and it's very important to do this, take the accounting or financial ratios and numbers that we just looked at and climb underneath those, drill down into critical operating processes, business activities that people can relate to and that we can measure on a current basis. So for example, if we're looking at the management of profitability on the left-hand side and we drill down and eventually get to people costs and what the turnover is, learning and development expenditures, productivity, things that drive the overall productivity and utilization and cost of people. And on the balance sheet side, we can climb underneath receivables and DSOs and inventories and inventory turns or DSI, and look at payment terms and past dues and the effectiveness of the credit process, and for inventories, the effectiveness of our supply chain. And again, we can develop these measures and we can develop conceptual, if not mathematical, relationships with the financial outcomes. So what's the difference between ROE and ROIC, you ask? Well, quite simply, it's leverage. And what we have here on the top for Robert's company, we have the ROE presentation, the DuPont formula, where we take profitability times asset turnover times financial leverage to come up with the return on equity of 50.8%. So it's important to recognize the profitability is a little bit different in ROE in that it includes or reflects interest expense and non-operating income. So it's really the net income available to all shareholders. And so financial leverage is also taken into account, obviously, with this one. So with return on invested capital, we do not consider financial leverage. That is, we're going to look at all invested capital. And so it's going to be profitability times investment turnover. The profitability is going to be operating profits after tax. So it will generally be a higher number than net income, presuming that the company has net interest expense on the debt outstanding. Return on invested capital, the investment turnover is going to be close. It's defined a little bit different. It's net assets, so it's not assets, so there will be a difference. And again, ROE reflects the financial leverage, debt and non-operating income, assets and liabilities. ROIC is good because it drills down into the operating performance and is not impacted by financial leverage. So you can compare companies that have different capital structures. For example, a highly leveraged company to a company that has no financial leverage, and have a apples to apples comparison. ROE for those two companies would not be an apples to apples comparison. So very useful and very important, both of these measures. They allow us, when we start thinking about ROE and ROIC and beginning to decompose those formulas and look at the drivers, we can compare performance of a company, in this case Gladner, to other companies in the technology business and a couple of wildcard or best practice companies. So we can look down below at ROIC, and we can go back up and look at asset turnover, and we can look at profitability levels, and we can see how the key things like gross margin percent, SG&A percent, inventory levels, receivable levels impact that across each of these companies. We can also then link this into valuation, the enterprise value as well as relative value metrics. And we talk about valuation and specifically valuation using comparable multiples in another video under the valuation playlist. So this can be a very interesting exercise. We will also have a separate video on benchmarking because it is a powerful tool for FP&A and finance professionals. So if we come back to the value performance framework then, a measure like ROIC covers really 6 of those drivers. It includes certainly profitability in all respects, reflecting pricing strength as well as operating effectiveness, capital management, and the cost of capital is really the benchmark or hurdle rate that we would compare ROIC to. What it doesn't include is any accountability for growth. And this is an important tension because generally these two objectives work against one another. That is, if we invest more in growth, it is going to have at least a short-term negative impact on our profitability and our asset turnover and therefore return on invested capital. So we have to look at growth as well. And so if we drill down underneath that growth driver, we can separate out acquired growth versus organic growth. And the drivers of growth include new products and services, the contribution from that activity, retaining and growing existing customers, very important to do both, acquisition of new customers, looking for whole new channels of distribution, maybe digital, maybe a new territory, and then finally what's happening to the overall market and market growth and the competitive environment. And of course then we can drill down further and look at the actual activities and business processes that will lead to revenue growth from, for example, new products and services, and focus in on the product pipeline and how we're serving customers and what new channels or new customers we're in the process of acquiring. So we got to take a look at growth ultimately and combine growth and return on invested capital to have a complete performance management system in my experience. Okay, so what is economic profit and EVA? EVA was popularized by Stern Stewart in the 1990s. It essentially is a very refined methodology under what I think of as the economic profit model. And really what we're talking about with economic profit is to say, look, if we take net income, we need to understand that there's a lot of capital employed in order to earn that net income. So we really should look at the returns after a capital charge. It's computed as shown there. We take the operating profit after tax. Now this can be computed in the same way we compute operating profit after tax for ROIC, or it can be computed differently as EVA does. And then we take a capital charge, which is the invested capital, again, can be computed the same way that ROIC is computed, times our weighted average cost of capital, in this case 12%, and the economic profit then takes the operating profit and subtracts the cost of capital from that to come up with 11 million in this case. So it is consistent at the highest level with ROIC. Again, EVA recommends many adjustments we'll talk about in a minute. It considers growth because we can look at year-over-year improvement of the economic profit number result, and growth in revenue will be accounted for in this measure. Sometimes it's implemented in a very complex financial manner. For example, we may adjust income by things like capitalizing R&D with a very reasonable assumption, but very different than accounting results, that R&D is an investment in the future and should not be considered an expense. And things like treatment of leases and other adjustments that sometimes make it very complicated for operating people to understand, especially when many have difficulty with basic financial models and terms, and then we complicate it a bit with a lot of adjustments or changes from the traditional accounting measures. So on the right-hand side, we highlight the computation there, looking at 2023 is the one we highlighted on the left, and you can see the components of this. So we can look at the drivers in terms of profitability, operating profit after tax. We can look at what's included in net investment. We can manage that. We can control that. We know how ROIC is computed. It's the product of those two. And then down in the lower right, we calculate economic profit by taking that OPAT, the net investment, and capital charge. And then importantly, again, we look at the year-over-year growth in that. So economic profit can grow, in this case, from two separate things. One would be an improvement, actually three, an improvement in the management of the net investment. So if you have a higher net investment turnover, lower net investment, you will have a lower capital charge. You can also reduce the cost of capital by reducing risk and by perhaps restructuring the capital base. And finally, we'll have a change in the economic profit. Sorry. So those three factors can be used. You got three levers to control that. So ROIC and economic profit are consistent. And if they're defined consistently, they will yield consistent results. So if ROIC is greater than the cost of capital, economic profit is greater than zero. ROIC is equal to cost of capital, the economic profit would be zero. And if ROIC is less than the cost of capital, economic profit is less than zero. So you can see that illustrated for Sheridan Express Company in table 6.8 there, that EVA is neutral in the middle case, the break-even level, where the capital charge is equal to the operating profit after tax generated. Economic profit is positive, 7.3, where OPAT exceeds that capital charge. And we've got, in the other case here, where value dilution occurs, economic profit is negative because ROIC is less than the cost of capital. So, a comparative summary here. We've got the measures and we've got the pros and the cons. We talked about the fact that EPS and net income measures are ubiquitous. They're everywhere. You can't get away from them. So I choose not to ignore them, but to complement them with these other measures. Return on assets reflects asset requirements. That's good. Doesn't consider net assets, that is the operating liabilities. ROE is a good measure. It focuses on equity returns. It reflects financial leverage. That's also a con because you can't compare similar companies that have different capital structures because of the impact of financial leverage. ROIC is a very good measure, also called RONA, ROCI, RONI, return on net investment. That's the one that I grew up with and later was responsible for overseeing the corporation I worked for. Pros for those measures: sound economic measure of performance. They reflect the capital. They're suitable for operations. The negative is it doesn't consider revenue growth. So if we add in the next column revenue growth to ROIC, then we've got all the value drivers accounted for. It's suitable for operations, reflects growth, consistent with economic profit. The only downside is it's not a single measure, it creates two. So you can have two measures shown. Back in my day, we used to reflect both the growth rate as well as the profitability and the return on net investment. EVA, economic profit, we've got the formula up there. It reflects invested capital and the cost of capital. It's a sound economic measure of performance. It is consistent with ROIC as we illustrated. It can be complex if applied in the absolute technical sense because the creators suggest a lot of adjustments to the reported accounting results. And while all of those have merit, all of those adjustments to get to a better measure, sometimes it can cloud the relationship between earnings, which will always be important, accounting earnings, and this economic measure. So I prefer to go with an 80-20, get capital in the measure, that's the most important thing, and don't worry about all of the secondary adjustments unless they are really significant. And again, we want to influence behavior and management. I also find that operations often contest the cost of capital and fight with the corporate group, the corporate finance team, over the reason why there's not more capital or leverage in the capital structure to reduce the cost of capital and so forth. So how do we build shareholder value using these measures? I think a big step forward is to adopt ROIC/G or EVA, economic profit, as a key performance indicator, because what gets measured gets improved. And even if it's not the primary measure, I have found success just putting it on the dashboard, putting it on the key financial summary, because you can begin to talk about it and focus on it. Growth is very important, so you can have organic revenue growth, you can have an effective acquisition process. Profitability obviously impacts this equation. Asset management and investment turnover, and this is a real benefit of these two measures because when we consider the capital employed in the business, then we're incentivized to improve the underlying business processes and reduce the level of capital we have tied up in things like receivables and inventory, and also evaluate very clearly and understand the implications of capital investment decisions. We can also think about reducing risk by reducing volatility that the company has, and perhaps restructuring the capital base. So, in summary, the great metrics debate, overall measures of financial performance, and I essentially have lived through this my entire career. I can remember this debate going in significant fashion back in the early 80s. We have to remember that the overarching goal of corporations is to create value for shareholders. So we really should look for measures, and it might be more than one, that really represent and focus our attention on those drivers of long-term shareholder value. The income measures like EPS and return on sales are incomplete measures of performance since they don't consider the capital required or the cash flow requirements or generated by the operations. The measures like ROA, ROE, economic profit, and growth each provide specific insights and have value. And very often in my analysis, I will use all of them on a key financial summary because they shed just a little different light, a little different perspective on the performance of the operation. You might consider watching other related videos, financial statement analysis. We'll be recording soon enterprise performance management, performance measures and dashboards. The cost of capital, valuation, and benchmarking is also coming soon. I hope this was helpful. Good luck to you in your careers. If you enjoyed the video, benefited by it, please like it and also subscribe to the channel. Have a great day. Thanks.